When KiwiSaver balances were worth little more than a cheap used car, most of us didn't really see it as the serious retirement vehicle that it could become. We were probably all still banking on property, if we owned property, to get us across the line for retirement. But with the market flatlining in the property space and getting fresh scrutiny because of its non performance, suddenly KiwiSaver is back in the spotlight and right on cue with the government's lifting the contribution rates from April of 2026. It's a step up, yep, but is it waiting for Wellington to take charge really the limit of what is possible with KiwiSaver? Or more importantly, can't we intelligently tweak KiwiSaver or other retirement strategies for that matter for even better performance? So today I'm going to show you exactly how to turbocharge KiwiSaver. 3 practical upgrades that you can actually make so that you're not just riding on the government's standard model, but you're building real performance and control into your own retirement vehicle. Now, for those that don't know me, my name is Darcy Ungaro. I'm a Canadian-born, not American, financial advisor here in New Zealand, and I work with everyday investors who want to think deeper about how money actually works and who want to exercise greater control of their financial decisions. Now, the first way to turbocharge KiwiSaver or any investment strategy for that matter is the one that you have absolute control over. Just like a car, if you want to go faster, you give it more gas. More money going in means that you reach your retirement goals faster. It doesn't need to be any more complicated than that, but often this is the first thing that most of us overlook. Now, for comparison, because we all love comparisons, Australians right across the ditch there have 12% of their pay going into their superannuation, double what a lot of us have been running on with the old 3% each from you and the boss going into KiwiSaver. But from April this year, the default here will jump to 3.5% and then eventually to 4% in 2028. That's better than before, no arguments there, but it's miles off what we should be doing considering changing demographics, rising infrastructure costs, and the very real risk that New Zealand superannuation from the government will either be means tested or inflated away into nothing by the time we're able to enjoy it. But why stop at just this minimum amount at 4%? I want to show you this example of a client of mine, 40 years old, on $100,000 with a balance of $100,000 in his KiwiSaver fund already. On the left is his scenario where 6% of his salary was invested into KiwiSaver for the rest of his 25-year-old career. And his forecasted balance at the age of 65 was just under $670,000. This would enable a theoretical spend, by the way, of just over $31,000 a year from age 65 to age 100, assuming he lives that long. On the right, though, is what it would look like if 8% was invested instead. Although it cost him an extra $25,000 to put in that extra 1% himself, the balance at age 65 is almost $90,000 higher, and he has another $4,000 a year in retirement to spend. Now, what would that look like if he Aussieified this and he contributed 6% with his employer matching that to make it 12% overall? $933,000 at age 65 with almost $44,000 a year to spend for 35 years. Fair income. So chuck more fuel on the fire or in the carburetor if you like. You'll go further and you'll get there faster. And no, it's not perfect having your money locked down until age 65, but isn't that part of retirement planning? Being forced into locking down your money for future use? So I kind of just think of it as it removes my money from my own reach and it avoids any temptation to invest into something that is less structured, which I kind of need. So just acknowledging though that it is an option for retirement, the old KiwiSaver, but it is not the only vehicle. Just make sure though that if you're not doing it, you are doing something that's equivalent to this in terms of long-term retirement provisioning. But that's the first upgrade. Just invest more. Simple, quick, quiet, and powerful. Now, for those who don't want to or they can't contribute anymore, kind of like the car that has all the fuel that it can ever carry, probably because you lost the key to the fuel cap perhaps. Well, here's the good news. With this second performance upgrade, you don't need extra cash for this one. All you need to do is adjust the fuel to air ratio or change the amount of growth assets relative to income assets within KiwiSaver if the road ahead is long and you can handle the change in ride that you're likely going to experience from doing so. But let me break this down as simply as I can. If you ensure there's a high degree of shares and other growth assets being invested in within your KiwiSaver, instead of a high amount of cash and bonds, you're setting your portfolio up to do more heavy lifting, kind of like you're creating a more direct pathway between the power that the engine can produce and the power that's actually being put down on the pavement through your wheels. Most KiwiSaver providers, though, will have 4 to 5 preset funds that all have different ratios between these growth and income assets. And here are the 3 that you might be most familiar with. You got the balance fund, where there's around 60% of your KiwiSaver invested in shares, and the remainder will be into cash and bonds. Growth, where 80% or so is in shares, or aggressive, sometimes called high growth or even pure equity, where we can have up to 99% invested in just shares. Now, remember, growth assets or shares or equities can often comprise of units of ownership in actual businesses that become more valuable over time and might even spit out dividends, earnings that you can share in. But they can also be things that don't produce any cash flow at all, but may rise in price over time regardless. Gold, Bitcoin, oil, and other commodities as examples. Now, cash, on the other hand, is like money in the bank, which potentially earns a little bit of interest, and bonds are fixed investments that generate predictable cash flow and more certainty around getting your money back in the future. Balanced growth and aggressive KiwiSaver schemes have different levels of growth assets within them and also come with different levels of volatility, which is the degree by which the entire portfolio may change in value over time. Now, generally speaking, the more shares that are in your scheme, the more there's going to be some changes in the value of your portfolio over time. And over the long term, it is more likely, not a guarantee, but it is more likely that you will get a higher rate of return relative to the fund that has a higher amount of income assets within them. Potential growth and income. It's always a trade off, it seems, between a capital gains strategy and a yield strategy. You see it with property, shares, and with KiwiSaver as well. So if a larger return is what you're after, and of course, we're all going to say yes to that, right? But if that's what you're after and you're very confident in your own ability to stay still when scary stuff happens in the world, maybe think of a debt collapse, war, alien disclosure, something you did not genuinely see coming. If that happens, are you going to be okay? Well, if so, go for the maximum amount of growth assets that you can. It will be a bumpy ride, but it will get you further, potentially faster. Just remember, chasing higher returns will almost certainly come with more frequent and more severe changes in price. It's a bumpier road. But personally, I look at it like this. The danger isn't just crashing the car at speed. The danger is actually in jumping out of the car at speed. And it's not the wobbliness of the investment itself that you need to worry about. It's the wobbliness of yourself as the passenger that's the biggest risk. Now, it may sound like a no-brainer to dial up the percent of growth assets at this stage, but I really do need to stress that this is a nuanced space. Corrections in the market are normal and they will happen. They will always happen. And the best answer is almost always just to hang on tight right on through the volatility and don't capitulate. Don't change from a growth and go into a balance when you get scared. We need to watch out, though, for deeper secular changes, though. These aren't just bumps along the way. These are events that start something new or end something old. Geopolitical uncertainty, war, or the reversal of a 40-year trend of declining interest rates. Sometimes it's just a 7 to 10-year wobble and we'll get over it. Other times, though, the bridge is out up ahead. No matter what you do with your KiwiSaver or your retirement portfolio, just don't fall into any trap in how you think you should invest going forward. Any rules are there as guidelines and they are meant to be adapted over time. But yes, for the most part, and as a general guideline, stay in growth when you have more than a decade to go. Pour in more fuel, adjust the mixture, and the third option to more KiwiSaver turbocharged goodness is this:
The custom rebuild.
Now, if you have ever taken things apart, put them back together, and then discovered a few extra random screws left that you don't have any holes for, I'm right there with you. Now, I want to cover the strategy of diversification in a little bit more detail before going further. Diversification, aka the shotgun approach to investing, involves spreading your investments into many different sub investments or subcomponents. Income assets will be split into cash and bonds. Bonds will be long and short dated, corporate and government, local and international. Growth assets will be shares. They might be infrastructure assets, dividend yielding companies, commodities, and other things. And these investments might potentially be in different countries, different sectors, and adhere to different thematics. And here's where I will insert a quote from the famous Warren Buffett. Diversification is protection against ignorance and makes little sense if you know what you're doing. Now, that may be true, but diversification, especially for those without any investment knowledge whatsoever, or without investment knowledge in a specific sector that you might want to get exposure to, but you don't know which companies are the best, it still actually works pretty well. And one of the reasons why broad diversification, like the shotgun approach properly to investing, works is because of our financial system. It's constantly being crammed full of new currency through governments, through corporates, and through private individuals going to the banks and conjuring more money into existence every time we borrow money. This constant credit creation dilutes our denominator. Every investment that we own, if it's denominated in dollars and those dollars are losing value, makes it appear that things are more pricey or more valuable than what they really are. It forces all assets to rise like an incoming tide. So yeah, you don't really need to overthink it too much if you're relying on the eighth wonder of the world, compounding returns, and a diversified strategy. But diversification, when liberally applied, can limit the amount that a KiwiSaver fund can change in value by as well. Now, that's good and bad. It is a volatility reducer because even if one investment fails, it would be unusual for them all to fail all at once. Over time, though, diversification can force an investment product, which might feel risky, into a savings account. Now, remember, they call it KiwiSaver, not Kiwi Investor. So the next time you're making some decisions around your KiwiSaver, just ask yourself, am I happy with a lot of diversification, or am I willing to take on board a little bit more of a bumpy ride to get further faster? But KiwiSaver industry participants, whether it's financial advisors or regulators or even fund managers, they all want the value of the investments to rise over time. But they also at the same time need to be aware that not all investors have the degree of volatility tolerance required to chase high returns. And when investors are also likely to judge performance based on steady, reliable returns, it's no wonder why most providers will offer more diversified strategies rather than concentrated strategies. And I guess there will be some who may disagree with me on this, but I'm going to say it anyway. KiwiSaver can be a high performance investment vehicle, but most of us prefer to drive around with the engine detuned so that we feel safe and we don't drive through a fence. But how do we rebuild KiwiSaver for better performance if that's what we want? Simple. What's the opposite of diversification? Concentration. We put more money to work in a fewer number of investments, not more. This is how you get larger gains. But yes, and I can hear you thinking this already, and you're 100% correct. The bigger the potential is for a large gain, the larger the potential is for a large drop. A concentrated KiwiSaver plan with fewer investments in it will almost certainly spread out the range of potential return outcomes. Some very high, very positive, some very low, very negative. If you genuinely are a high conviction investor who understands that price volatility is actually just the price that you pay for performance, and if you understand there's a very real chance that you could even lose money in the process, then perhaps a more concentrated KiwiSaver fund is for you. So, what are the options, right? Well, if you choose more concentration, you need to look past the pre-built plans that are designed with diversification at its core, and you may need to consider some of the self-select options that are now available. Invest Now, Sharesies, Cura KiwiSaver, and potentially others now allow for greater customization. Yes, there are guardrails like limitations around how much you can invest in any one thing, but it's a great development. And one provider, KiwiWrap, which is only available through financial advisors, including myself, can allow for greater control of asset allocation without some of those restrictions that can frustrate those who have genuinely done their research. But the important thing here to remember is that if you do decide to do a custom rebuild on your engine like this, well, being smart doesn't make you an expert mechanic. Don't chase concentrated investments just because you're trying to copy the masters. Let it be a genuine, honest consequence of a rock solid conviction in what you've truly understood. It's a path born of insight, not imitation, and it's not suited to every capable thinker. But if you want more exposure to technology, AI, solar, space, Bitcoin, precious metals, defense, or if you want to steer clear of some of the ethical screens that your fund manager has inflicted upon you, or you don't vibe with all of it, then we have options now. So where does this leave us? Where does this leave you? Well, if you have KiwiSaver, I think you should use it as a serious platform for building wealth, not just a bit on the side. And not every configuration suits every driver. The April contribution change gives everyone, regardless of our employment status, a genuine reason to pause and reflect and review all of our retirement settings. Will we have enough? Are we on track? What changes do we need to make? Contribute a bit more where you can, choose more growth while the road is long. And if you want genuine freedom to concentrate on the future that you believe is coming, aligned to your own convictions, that's where I believe you can really feel the turbo kicking in. And if any of that sounds like a conversation that you've been wanting to have, then drop me a line. The link is in the show notes below. I'll walk you through whether a more custom setup might fit your situation. No hard sell, straight talk, 15 minutes, no charge. This isn't financial advice, of course, but I do hope it gets you thinking. We'll see you on the next one.
A special thank you to our show partners who help make this possible. Thank you so much, you're awesome. SwiftX and Provincia, thank you again. Want to connect on social media? You can find me on X and you can find me on LinkedIn. Remember, some investment strategies or ideas can make you obscenely wealthy or wipe you out completely. It's hard to know from this end what's best for your world. So if you can, reach out for some advice that accounts for your own circumstances. That's it for this one. Catch you next time. I'm out.